And today we're going over a stock in the automotive business that has been in the news almost all week long, and that is Tesla. And remember, folks, these methodologies are based on the book Buffett and Beyond, second edition. And remember, if you want to live on this beach like Jimmy Buffett, you've got to learn how to invest even better than Warren Buffett. And for you folks out there who have not tried our 2-week free subscription, just go and do it. Go to buffettandbeyond.com, put your name in, put your email. You'll be getting a letter every day with analysis on several stocks a week. And you're getting 3 videos on Saturday, and every now we put an extra letter in between. But you want to try that free subscription. You get a lot more information than just the information that we put out on YouTube. And remember, folks, that in order to get the kind of returns that we're talking about here, we're talking about an investment portfolio that we buy in the beginning of the year. We hold it just about all the time, all year long, and then at the end of the year we replace any stocks that need to be replaced. And out of about 30 stocks, we replace 5 or 6 a year, and we rebalance and we hold it for the rest of the year. So we are looking at longer term portfolios in this part of the letter anyway, and since 2002, so we're looking at over 20 years here, folks. Our portfolio up 1,061%, S&P 500 up 377%. So again, our growth model portfolio, and if you subscribe to our newsletter, you get those 30 stocks, and we keep track of them for you all the time and keep you exactly up to date on your portfolios. And those are individual portfolios, but the growth portfolio is primarily buy and hold, with changes that have taken place on the last trading day of the year. And so let's look at Tesla, and let's look at the numbers on Tesla. Now, the lines in blue are the average stock in our portfolio. There's about 1,800 stocks in our portfolio. The average stock gives you about a 13.5% return on equity. Now, this is a different type of return on equity, but the simple way to think about it is your bank account. Do you want the average stock bank account, or the S&P 500 bank account, or the Dow bank account paying you 13.5%, or do you want bank account Tesla that's paying you 21.4%? Then when it comes to net income, how much you're actually making, average stock about 13% over the years, and Tesla about 50%. And I'm going to go over this number in a second because it's really higher than this, but it's astronomically higher. I'll show you that in a minute. Revenue for the average stock, 7.1%. For Tesla, 34%. So we're looking at almost 5 times the average stock, the revenue of an average stock. So therefore, revenue eventually falls down to the bottom line right in here. So you want that growth in revenue so you can make more money. Now, let's think about Tesla for a second. All the cars are or will be mandated by the government in the future. Everybody's got to drive an electric car. Yeah, I'm fighting it, but it's got to be done. And Tesla is a brand name relative to its products, just like Coke or Heinz. When you think of a cool soft drink, you think of Coke or Pepsi. When you think of ketchup, you think of Heinz. When you think of tissue, you think of Kleenex. When you think of an electric vehicle, EV, you think of Tesla. And don't forget that Tesla is making money, as we're going to see. Ford lost $3 billion in its EV category this past year. $3 billion. Yep, you heard me right. Now, Tesla doesn't use dealerships, so it's saving a big cost of the new car. And Tesla is a battery company? Yeah. Charging stations? Yeah. Elon Musk, he's a character in itself. Self-driving cars. He just came out the other day and said, we're ready, almost ready with these self-driving cars. So here we go, folks. It's got a lot of things going for it. I don't particularly like car companies. Tesla is the only car stock I've ever owned. So let's look at the owner's equity, these charts. Owner's equity. Think about the 2 things that make you money if you put money into a bank. Number 1, the amount of interest that the company or the bank is giving you, and the amount of money you have in the bank. So if you can combine a lot of money in that bank with a high interest rate, you're going to be making a lot of money each year. So when we look at owner's equity, and this is in the clean surplus condition, folks, don't forget to read that book. So we're looking at the clean surplus owner's equity, and think about that as the money you have in the bank, or the value of your bank account. And you can see that every year it has been going up, with the exception down in here. But once it got going, it goes up every year because it's making money. Now, when we look at the clean surplus return on equity, the average stock gives you a clean surplus return on equity of about 13%. So if you get into a stock or a company that is making more than 13%, you should have an above average portfolio. Under 13%, you're going to have a below average portfolio. So we not only go above 13%, but we want to see about 20% in the stocks that we put into our growth portfolio. And don't forget that over any 10-year period, and this is a Morningstar report from 2002, and it holds true to this very day, that 96% of professional portfolio managers who run the publicly traded mutual funds, 96% cannot outperform the S&P 500 over that 10-year period. So if you invest in stocks that have a 13% ROE or above a 13% ROE, you'll have an above average performing portfolio. And that's what the research shows, but we'll show you that in a second. I want to go over retention rate. That's how much the company is making and puts back into itself. So Tesla is taking all the money it makes and put it back into itself in order to grow. Net income growth, and this is what I was talking about. If we go over here to this net income growth from 2020 to 2021, net income growth, this is about a 750% growth. So if we put 750% in here, the net income growth would be on average about 180%. So we left it out and we only took a 3-year average here, which is 50%. Again, way above the average stock by about 4 or 5 times. Revenue growth, we went over that already, 34% with the average stock out there, about 7%. So we're looking at 4 or 5 times the average stock. Low debt, years to pay debt. If a company takes all the money it's making and uses it to pay off the debt, how long would it take to pay off the debt? Warren Buffett says 5 years or less. We say 3 years or less, and this company can pay it off 1.7 years. So Tesla is not affected very much at all by rising interest rates. So let's see what this stock has done. Tesla stock has done year to date. So we're looking at almost 7 months now. Black line is the S&P 500, up about 19% as I'm recording this, which is Friday afternoon, and Tesla up here up 140% year to date. And don't forget, this is after the big decline that we had on Thursday and part of Friday. In fact, on Friday, as I'm recording this, it's starting to come back already. So we're still near the top here, folks. So these numbers that disappointed about the projections because more companies are coming in and making cars, and Tesla continues to fight for market share, and therefore they say, well, if you fight with market share, that means you have to lower your price, which means you're going to lower your earnings. And that's what all the hullabaloo is about on Wednesday and Thursday, actually, with Tesla. So we see it's still right near the top and looks like it's turning around as we speak. But anyway, it's up around 140% while the market is up about 19%. And then when we look at 5 years, just ridiculous, folks. Market up. Black line is the market, up about 50%, and this stock up about 1,300%, even after the decline on Wednesday and Thursday. So, folks, doing very, very well with this stock. And remember, if you want to live on this beach like Jimmy Buffett, sit in the shade and watch all the people swimming on the beach, yeah, you want to be able to invest even better than Warren Buffett. So, folks, don't forget that 2-week free subscription and just sign up. Give us your email, buffettandbeyond.com. Buffett is spelled 2 F's and 2 T's. Folks, we'll see you there. You'll get a letter every day. You'll learn an awful lot about stocks, and you get a free PDF copy of our book when you sign up for that two-week free subscription, so you know what this methodology is all about. All right, folks, have a good weekend. We'll see you back here next time.